Welcome to the Deep Dive, where we take your source material and distill the crucial knowledge you need to be genuinely well-informed.
And today, we are plunging into one of the most foundational shifts happening globally.
Digital transformation in finance.
We need to be clear about what that term actually means, though. This is so far beyond banks just upgrading their software.
Right.
We're talking about a profound systemic shift moving from these legacy, often paper-based systems to something completely, technology-driven, data-enabled, and just relentlessly customer-centered.
So it's about redesigning the entire financial value chain.
The entire thing, from lending all the way to customer onboarding.
That structural overhaul is key. And our mission for you today is to recognize that while this transformation is happening everywhere, the strategies, the priorities, the actual models, they differ dramatically region by region.
That's right. So we've extracted the approaches of three major global leaders. We're looking at the UK, India, and China to really understand their distinct recipes for success and, the lessons they offer everyone else.
Before we jump into those three, maybe we should quickly set the stage with the United States.
Yeah, that's a good baseline. The U.S. transformation has been robust, but it's characterized by, I'd say, massive cloud computing adoption and a regulatory shift towards speed.
FedNow in 2023 was a huge part of that.
A massive part. And for anyone unfamiliar, FedNow enables real-time, 24/7, 365 settlement of payments. It's a huge deal.
And it's driven by two forces, really. The giants like JP Morgan Chase and Bank of America modernizing their core systems.
And the FinTechs, the PayPals and Stripes of the world demanding new levels of convenience and speed.
But the U.S. model still relies heavily on incumbents adapting, right?
It's true. It's a great example of incremental modernization within a competitive but still very fragmented regulatory framework. But let's look elsewhere now, where the transformation was driven by something much more centralized.
Okay, let's unpack this with the UK. The sources consistently cite the UK as one of the strongest global leaders in digital finance. What was their unique recipe for getting ahead? Was it just faster tech?
No, it wasn't just faster tech. It was regulatory bravery. The UK's success, it really hinges on a regulatory environment that didn't just passively allow innovation.
It actively fostered it.
It actively fostered it, exactly. They realized that the big incumbent banks had, very little incentive to move fast, so regulation had to force the pace.
And the key mechanism everyone talks about there is open banking. But for those listening, why was open banking such a game changer?
It fundamentally shifted the power dynamic.
How so?
Well, open banking mandates that banks, the Barclays, the Lloyds, NatWests, they must allow third-party providers like FinTechs to access customer data.
But, and this is the key part, only with the customer's explicit consent.
Exactly. The control of the data moves from the bank to the customer.
So the real lever wasn't forcing competition, it was legally mandating partnership through APIs. And the Financial Conduct Authority, the FCA, they drove this.
They did, through innovation programs and these regulatory sandboxes. And this collaboration is the real heart of the UK ecosystem.
Which led to an explosion of innovation.
A total explosion. Across lending, payments, wealth management, the market was suddenly flooded with competitors who could offer these really bespoke, innovative services without needing to build a massive bank infrastructure from scratch.
And this enabled the rapid ascent of the now famous digital-only banks.
The Monzos, Starling, Revolut.
Right. They leveraged this open infrastructure to completely redefine what customers expected. Instant onboarding, intuitive budgeting tools, frictionless transactions.
But we need to acknowledge the friction here, too. This model, while fast, it created immediate challenges around data privacy and security.
Of course.
When you mandate the sharing of sensitive financial data, even with consent, maintaining trust becomes absolutely paramount. The UK had to invest heavily in ensuring the security protocols were watertight.
So that's the global lesson then. The UK shows how strong forward-thinking regulation, combined with the necessary focus on security, can actively accelerate transformation. It really is the regulatory pioneer.
It is. Now let's pivot completely.
Here's where it gets fascinating. India's transformation was just as rapid, just as wide scale, but it was driven by a completely different engine.
Completely different. India's success isn't built on private sector fintechs or a top-down mandate forcing banks to open up. It's built on a unique foundation of massive public digital infrastructure.
Designed explicitly for mass accessibility.
And scale. Unprecedented scale.
Yeah.
We're talking about the India stack specifically, the Aadhaar National Digital Identity.
Coupled with UPI, the Unified Payments Interface, for real-time payments.
And this is just a radical asymmetry compared to the West. The government essentially created the foundation, the pipes, the rails for digital identity and payments, and they're nearly free to use.
So that just drastically reduces costs for every single bank and fintech in the country.
Exactly. It's infrastructure acceleration. FinTechs don't need to spend millions verifying identity or building complex payment infrastructure from the ground up.
They can just focus on the application layer, the stuff the consumer actually sees and uses.
And the scale is just staggering. UPI transactions often exceed billions per month. It allows, say, a street vendor to accept an instant digital payment from a consumer at virtually zero cost. That's why financial inclusion expanded so rapidly.
But the sheer scale of rolling out something like Aadhaar must have involved massive challenges. I mean, you can't implement a national digital identity for over 1 billion people without some serious hurdles.
Oh, absolutely. Initially, there were serious legal and privacy concerns that had to be addressed, and major implementation challenges in rural areas without connectivity.
So what drove the adoption?
The sheer utility of it, the immediate benefit of getting access to all these low-cost services was just too compelling.
And technologically, banks and fintechs are now building on top of this, using AI for credit scoring, for fraud detection.
Right. The data exhaust generated by UPI is massive and incredibly valuable. So India demonstrates this vital global lesson, how coordinated state-level infrastructure can accelerate transformation, focus squarely on expanding financial access across a massive, diverse population.
It's a template for many emerging markets.
For sure.
Okay, now let's move to China, where the model shifts again. It's not government regulation, it's not public infrastructure, it's the corporate tech giants.
In China, technology companies play these central, almost monopolistic roles. It led to a profound, system-wide transformation almost overnight. This is what we call the platform transformer model.
And this is all defined by the rise of the super apps. We're talking primarily about Alipay and WeChat Pay.
Which are completely integrated into daily life. They aren't just payment apps, they are entire ecosystems.
They house thousands of mini apps for everything from booking a doctor's appointment to ordering food.
They just radically reduce dependence on cash, almost instantly.
I remember reading a source that noted for a tourist in a major Chinese city, it's actually safer to rely on your phone than a wallet.
Right, because so many places stopped accepting cash or even traditional credit cards. It is total integration.
And that's the power of platform dominance.
It is. These companies built incredibly complex business models around digital payments, data, mini apps. They control the entire customer journey. And the digital banks they backed, like WeBank, they use advanced AI and cloud infrastructure at levels that often surpass what traditional banks elsewhere can do.
So if the UK's challenge was privacy and India's was implementation scale, what was the biggest inherent risk of the Chinese platform model?
The primary risk is centralization and regulatory control. While these platforms drove incredible efficiency, the government eventually had to step in to regulate their explosive growth.
Which showed the model's fragility.
Exactly. It showed the fragility when your core infrastructure provider is also a private company holding immense market power in data. The pace of expansion changed dramatically after that intervention.
But the global lesson remains clear. China highlights the unparalleled power of integrated tech platforms when they connect payments, lending, identity, and social ecosystems all in one place.
So if we step back, what does this mosaic of approaches, the regulatory push, the public foundation, the platform dominance, what does it tell us about the future of finance globally?
Well, it all means that every institution, regardless of where they start, has to get faster, more accessible, and more efficient. And they are all being shaped by the same universal technology drivers.
We can connect these drivers directly to what we just talked about. Artificial intelligence, for example, isn't just for automating customer service. In India, it's critical for handling the massive volume and detecting fraud on UPI.
And cloud computing is what enables the speed and the scalability of the UK's agile fintech ecosystem.
And data analytics and APIs are everywhere. APIs, application programming interfaces, they're the technical glue holding the UK partnership model together.
Right, and they're essential for what's called embedded finance, letting fintech services get integrated into non-financial apps.
To achieve all this, financial institutions are undergoing immense internal restructuring. They're shifting from being product-centric, we sell mortgages.
Could being customer-centric, how do we solve this customer's entire financial need?
Exactly. And that requires massive architectural changes, replacing old, monolithic legacy systems with things like microservices, which are more flexible.
They also have to adopt agile methods to respond to market demands much faster than they used to.
The role of the traditional bank, it remains essential, but survival requires continuous modernization. They have to improve their mobile capabilities and, critically, acknowledge that the fintechs introduce the standards of speed, simplicity, and transparency that customers now demand globally.
And this is a global phenomenon. We see successful transformation tailored to unique regional needs everywhere. Brazil's instantly popular Pix payment system, Kenya's pioneering M-Pesa mobile money ecosystem.
And even Saudi Arabia's new open banking framework. The trajectory is shared, even if the method is different.
That shared goal is what matters. Digital transformation isn't just a trend, it's the foundational infrastructure defining global finance now.
And whether you're operating under a regulatory mandate or building on public rails, success demands a combination of strong regulatory compliance, secure technology, and continuous innovation.
The ultimate aim remains the same across all three regions. A financial system that is faster, more accessible, more transparent, and ultimately more resilient.
And though our sources detail these very distinct regional approaches, regulatory, public, and platform, here's something for you to consider. As global financial standards evolve, maybe driven by cross-border payment initiatives from hubs like Singapore, how will these fundamentally different models?
The regulated UK, the state-run India, the platform-dominated China.
How will they eventually be forced to converge, cooperate, or perhaps clash entirely? That's something worth mulling over as this global evolution continues to accelerate.